live, and you're going to be able to see this on Facebook, LinkedIn, and YouTube live. So if you can see it, please comment yes, so we know you're there, and to make sure that it's streaming. So today we've got a very special guest, Mike Frisby, who's a very big name in the UK sort of property business. I've personally known Mike probably for I think about 9 years now. And also I've been on some of his courses, had some mentoring from him, and learned a lot. And, you know, I've got great respect for his expertise. And also he's, as well as teaching, you know, property, how to make money in property, he also walks the walk, and also he's acquired a sort of massive portfolio as well, which so he obviously knows what he's talking about. So yeah, it's been a great pleasure having him here on the show, so he can just explain a bit about his own journey, how he got to this position in his career and so on, and his property business, and also to give us some expertise how to maybe how to get started, and then also how to maximize the sort of cash flow and return on investment in property in a way that makes it a really good investment, even in today's uncertain market. So welcome to the show, Mike.
Well, thank you for inviting me. Yeah,
great to have you. So yeah, so we'd like to start just by talking about how you came to buy your first property, and then your sort of journey to where you are now.
Yes, so I started around about 15 years ago. I started off in the corporate world in marketing and strategy, working on some big, consumer brands that you find in supermarkets and pubs, because I worked on Guinness and I worked for Unilever, working on brands such as Dove and Lynx. And whilst I was there, I started, my interest in property was piqued because my own residential property seemed to go up and up and up. And I was thinking there must be a way to capitalize on this, because property always does well. I'm also fairly entrepreneurial, and I always wanted to run my own business. So I started off in the corporate world, but I always knew one day I'd probably end up running my own business. So business has always fascinated me too. And so I started, back in those days, 15 years ago, the internet wasn't quite what it is now. And the amount of information available to new property investors wasn't quite so much. So it took me quite a while to sort of research, learn and understand how to do it, because I hadn't even heard of buy-to-let mortgages when I first started. And I was thinking, gosh, you need a lot of money to get in. Well, of course, you don't need loads of money to get in. You just need the deposit. And once I discovered that, that really got me going, because you didn't need as much as the whole house. And the next thing I learned was you need to get a good deal. And if you get a good deal, you're buying right, then you're safeguarding yourself. And I was always told that property was sort of go up or even double every 7 to 10 years. I don't think over this period it has quite done that, but it's certainly increased. And it certainly, I think, will continue to increase over time, because we've got a shortage of housing in this country. And with our planning laws and everything, it's going to remain that way. We're an island, and there's only so much land in the country, and there's only so many places you can build, and our population is growing. So there will always be a need. And even amongst these times, these COVID times, people still need somewhere to live. And in fact, where you live has become more important, because we're all spending more time at home.
That's right.
So it's become, better quality living is something that tenants are really, really looking for. So, that's, as my business has developed, I've certainly tried to, buy things that will be, a good quality accommodation for the tenants, and so that they do enjoy staying there. So while I was at Unilever, I went out and managed to buy my first property. I got a little bit of education and mentoring myself, and that really, really helped me, actually. And I think without that, I wouldn't have been able to get going. So I started investing. And as we all know, in times, there's always something going on, isn't there, in the world, which means big companies are always reorganization and changing and all of that. So that was happening to me within Unilever, and I was just getting fed up. I sort of left Guinness because that was going through a change, and went to Unilever, and then that went through a change. And I realized that actually the only constant in life is change. And that therefore you need to be able to adapt and learn and be comfortable with change, I think, and those that are successful are. And I think you've just got to ride it and then have faith in yourself. So as all of that was going on, I bought a few properties by then, because what I did
this was about, you say 15 years, that's 2005 you bought.
Yeah, about 15 years ago. I think the very first buy-to-let property was in 1996, I think, so just under 15 years ago. Yeah.
1996, 24.
Not 1990, yeah, 19, yeah, nine, no, sorry, not 19, 2000s. Must be
2006, yes. So
yes.
14 years ago.
Time. Yeah, not 24 years ago. About 14 years. So yes, about 14 years ago.
Which literally was just a year before the big crash, wasn't it?
Yeah, so it was, it wasn't the best time. It wasn't the best time at the time. The properties had risen, and I thought, right, this is it. And I went, right, okay. Through change, I got an opportunity to take some redundancy, leave, and I just thought, well, I've got 6 months to really make this happen. Right. If not, I'll have to go back and get another job. And fortunately, I'm here this many years later. I still haven't gone back and got a job. I think I'm potentially a little bit unemployable, having got
join the club.
But yeah, I then went out and built my portfolio. And the way I did it was I did a lot of direct to vendor deals. That was part of the mentoring I received, was direct to vendor deals. I was to market. I knew and understood how to market through my marketing channels.
Which means leaflets.
And I did a lot of leaflets. Yeah. As probably my main source to begin with was leaflets.
Right.
And buying genuine deals. You hear a lot about people talking about below market value property, BMV deals.
Yeah.
And BMV deals, some people say, oh, well, I'll get that cheap. Then they do a refurb, and then actually it's worth what it's worth. That's not, to me, a BMV deal. A BMV deal is when you genuinely buy at a discount, and you might have to do some work, but if you add the work up as well, you've still got a discount to what it would be worth. Probably.
Right. So that's the key. So I think in those times, I think normally in a property market that's rising every year, you don't need to be that intelligent about buying it. You can just buy it as long as there's a good cash flow yield.
The good thing, yes. The main thing, and that was one of the things I probably didn't do enough of in my early days, was concentrate on yield, concentrate on income out of profit, concentrate on what profit, because everyone was so obsessed with capital growth because it's just been growing and growing and growing. And I heard of investors who buy chunks of terrace properties up north and not even bother filling them because they felt, why bother? It would just go up in value and I'll sell them in 10 years or remortgage them or whatever, and almost left them empty because they felt the capital growth. Well, of course, what we had coming around the corner was one of the biggest storms in the financial market ever. So that kind of stopped me in my tracks a little bit because obviously, I was getting lending, I was then recycling my money. So if you understand, even if it's on a simple basis, if you buy something and it goes up in value, you can remortgage. You pull some money out and then you buy another one. And that's how a lot of people built their portfolios.
Cool.
I just sped that process up because instead of waiting for the market, I actually could, because I was buying at a discount, I could do that a lot quicker. That allowed me to buy in my first year, around 20 properties.
Really? Just in your first year you did that?
Yeah, I don't know if it was my first year, but certainly when I jumped out of Unilever, it was around 20 properties because I was also, if you include, I'd buy a few blocks of flats that counted. So I might buy 8 flats in a block was one of the deals I did, and there's some other deals. And I also found some landlords who were selling up. So I bought a portfolio.
Because I think in those days you could get your money out on day one, couldn't you?
A lot quicker.
Yes. Because there were a lot because before the big credit crunch, there were a lot laxer about.
They didn't have this rule around 6 months that they now have. It's not law, but it's what most mortgage, not all, but what most mortgage lenders are comfortable with because they want to see you put some money in and want to know that there's, that you've stuck around for 6 months and that there's a distance between purchase and sort of revaluation. But in those days I could do that a lot quicker, which allowed me to buy a lot quicker. So that allowed and accelerated me. Now you probably can't go quite at the same speed if you want to do it all with your own money unless you've got wads and wads of cash. You can still recycle your money and the principles are still you can still adhere to the same principles. And really, I've done that throughout time. And more recently, I've been doing high-end HMOs, and
yes,
by changing the planning, by increasing the yields and the income out of a property, I get an uplift again, and then I can recycle my cash that way. So that's very much why I like the HMO strategy these days.
okay, because the idea with an HMO, you can, instead of valuing it as bricks and mortar, you can value it as a business, which values it on the as a multiple of the income stream.
Yes, exactly. A bit like a shop is often, valued on valued on the difference, the uplift, etc., etc. So you value it on the income if you've had a planning change away from a normal house. So there's normal residential houses are planning status C3, HMOs are C4. So if you have 3 to 6 people in an HMO, they're classified as C4. If they're 7 and above, they're called sui generis. So in some areas, you can just change it from a C3 to a C4 under permitted development. In some areas, local councils have taken that right away through Article 4, and you have to apply for planning permission from C3 to C4. So it's always worth checking with your local council.
So the general principle, I mean, that you've been following all along, is you sort of buy a property that yields enough cash flow so that it covers the mortgage. So you know that whatever happens, assuming you can get tenants for it, so an area of good rental demand, that you'll always be able to cover your cash flow. So, and then at some point, you're going to be able to remortgage and get all your money, all your deposit out. So effectively, your investment to that point of the property is zero, and anything after that basically gives you an infinite return on investment, which is incredible. And obviously, to start off with, you started off quite simply, just buying properties, and then you found ways of buying them more cheaply, buying leafleting, direct to vendor, which meant you could do that quicker. And in those days, it was a lot easier because of the mortgage rules were a lot easier anyway.
Yes.
So over time, although they've made the mortgage requirements tougher and made it harder to draw money down, this strategy is still possible. And also, especially if you have good cash flow, because often that is the big restriction in how much money you can draw down and remortgage. So
that's right, especially in the south of England, parts of London or whatever, the rents and yields are fairly low because the capital values are quite high, the actual values are high, so you can't always sort of push the mortgage up to high loan to values to allow you to recycle. So if you do HMOs in those kind of areas, you're more likely to be able to pull us more money out. But it's always good and wise to make sure you're always focusing on the cash flow. And that was something that, through the credit crunch, I really changed my focus from buying capital appreciation and discounts into focusing on cash flow. So I'd always recommend anybody starting out now, buying good rental areas, buy with good cash flow, make sure that's where you're getting your money. And almost capital value, is going to happen, but I regard it more as a bonus. And if I can refinance something later on, I will. But I do try and recycle as much.
And this is buying with good cash flow is definitely the safest way of doing it, isn't it? Because if you don't do that, you're exposing yourself to a lot more risk.
That's right. And as we can see, markets go up and down, interest rates can go up and down. So it's always good to have a good and you've got to be able to cover your rent. Your mortgage from your rent. And if they don't pay for a while, you need to have some buffers. If you've got a portfolio, that's easier in my mind. It's a little bit safer to have a few more properties than just one, because if you're relying on one and that disappears, all your rental income is gone. Whereas if you've got a few more, say if you've got 10 and only one disappears or one is empty, then you can probably cope with that a little bit more because you've got the others helping you to support it. So I do think, it's worth thinking about how many do you want, what am I trying to do, and making sure that you de-risk yourself as you invest, because it, like all investing, there are risks to it. If you know what you're doing, I think this is one of the safest forms of investment. You can touch and feel the investment. You can see the investment, unlike stocks and shares, Bitcoin and stuff like that. It's you move more and more futures options or whatever you do. It's there's lots of different things, aren't there, you can invest in, but you can actually physically touch and see.
Well, most people, I mean, yeah, most people who've got some money, want to invest in their future, they don't really know where to. A lot of them do invest in stocks and shares, but as you point out, that could equally quite easily go down, especially at the moment.
Well, I mean, if we look at now, some of the blue
Yeah,
chip companies who we thought through the test of time would probably be okay are really struggling. You've got, someone like M&S. Are the days really numbered for those? You would have thought, certainly 20 years ago, you would have thought, well, they've been here for a very long time. They'll be here for a very long time in the future. But, unless they adapt and change rapidly now, I'm sure they're going to be struggling, especially with all the rents that they have to pay, or if they own some of their own buildings, they're in a better position. But a lot of these big companies have big rents to pay. The top shops of this world in prime locations have rents to pay, and if sales have plummeted, then it's difficult, isn't it?
and also there's things that could happen in the global market. If America has a trade war with China, that affects the share price in the UK dramatically, doesn't it? So
yes, so there's a lot of things, I think, far more out of your control. Obviously, these economic times are affecting property, just like everything else. But I think it's far more steady. Someone always needs somewhere to live. And yes, if someone loses their job, there's going to be some problems. But then that brings me into, the whole social housing side. And through the last economic crisis, I got very involved in the whole social housing sector and understanding that. And again, knowledge is power. Knowledge is and being able to adapt to change. And just as the credit crunch happened and my strategy of recycling money quick disappeared almost overnight, I then really focused in on the income and the cash flow, and discovered that a really good way of doing that was in the social housing sector. And I didn't need to invest loads of money into the properties, which if I was setting up a big HMO portfolio then, I would have had to invest a lot of money. And of course, money was in short supply in the last credit crunch.
Yeah.
So to me, there's always strategies that you can employ in across the board. It's good to have a balanced portfolio. So again, in these times, my social housing tenants are great. And, there are some of my professionals losing their jobs or wanting to move, or, so it's good to have a balanced portfolio, I think, as well. There's something else
So suppose someone was just starting out and they didn't have any capital. What would rent to rent be a good place to start?
Yeah, so you've got two options. I think you've got two options if you're starting out. That property is a good thing to get involved in, and you want to get involved in it, and you know a bit about the market now. You've understood the tenant laws and those kind of things. And I would say there are two ways. One is the whole rent to rent, and rent to rent is where you guarantee or manage someone else's property, rent it out either to multiple tenants, so an HMO, or serviced accommodation, or to the social housing with some advanced strategies that I teach. Any of those three you can rent to rent. So you're basically guaranteeing a fixed amount to a landlord. So you could, for example, guarantee, say, £1,000 to a landlord. And if you can earn £2,000 out of that property, you can take the difference. The landlord's happy with £1,000, but you bump the rent up through one of those methods to get more rent, and you take the difference. And so that's a good way. And you don't need loads of money. You do need some money to start, because often you have to pay deposits on the houses. You might need to do a little bit of work to these houses. You probably need some, and you need a buffer, and you need to be sensible about it. And I wouldn't want people to get into risks, but there is a good way of doing it. And then you can get some cash flow that way. And also it shows experience to people, and later on you can save for a deposit or attract investors in. And I would say that's the second way, is work with people. If you've got a bit more time or find a really good deal, you'll attract someone who might be interested in investing in that deal with you. And you can end up joint venturing. So they've got the money, they may have less time, but if you've got a really good deal, there might be enough in it for both of you to do it. And that way you're using someone else's money and potentially your time and expertise. So joint ventures is, I've done a few joint ventures in my time. I've also used a few angel investors over in my time. So it is, you can use, as I said, back in the day, you said finance was easier. As it's got more difficult, you can work with individuals, who do have some investment, and there'll always be someone around who's got some money. And in times like these, as you're saying, Keith, people are always wondering, what do I do with my money? How do I get a good return? And property is a really fantastic way of getting a good return in these times.
Yeah, I mean, now I've also, even if there is a crash, I mean, I'm always thinking, oh, there's going to be a property crash, and I've thought that continuously. I think the last 20 years, and sometimes that, well, the big one was, of course, 2007, and then I thought there's going to be one with Brexit, but there hasn't been so far, and also with COVID, I thought there would be, but really, prices do seem to be sort of relatively buoyant compared to what they could have been.
Yeah, so there's a few big differences for me. I think, as you rightly said, I mean, Brexit's been dwarfed by this whole pandemic. So
yeah,
I think the effects of Brexit are all going to be morphed. The market did certainly slow once we voted out.
Yeah.
Once that kind of hit the market, there was a lot of uncertainty, and volume went down, and it just drifted. It didn't, prices weren't really going up. It just drifted. Up north, it was still doing okay because there was still that ripple effect coming out of London. That was the one that the place that picked up first, and then the home counties, and then the south, and then the north. So the north was still doing well, but certainly in the south, it had become stagnant anyway. And I think that was because of Brexit. They were waiting to see what's happened. And so there was a bit of pent up demand from that, because people have been sitting on their hands a bit. So when, Boris got in and there was some certainty, whether people liked the Brexit idea or not, they had some certainty. And I think that's what they were crying out for. We all knew we were going to leave.
Yeah.
And there was a little bit of positive activity. And I would say, January, February was busy. And then, of course, the pandemic came along and stopped that. And then that pent up demand has been released post lockdowns. And also, as I said, homes have become a lot more important to people. So I think people have been stuck in their homes and they've been thinking, should or shouldn't I move? All of a sudden, it was like, well, I'm not going on holiday. I'm not doing this. I'm not doing that. Let's put all of that money. Let's actually let's move. So in case we get locked down again, we've got a nicer place to live, or a bigger garden, or I don't have to commute. I'm not having to go into work so much. So I can live a little bit further out and get a bit more for my money. And then, the Chancellor gave people a stamp duty holiday. So that made the market really buoyant. So I think we're in a little bit of a false dawn at the moment. But, so I do think next year the market will cool off, because, we would have left Europe by then. We don't know what's happening with the pandemic, but there's going to be some after effects with the unemployment continuing to rise. So there is going to be a general sort of, I think a lot of people would have done their moving in the holiday, and then there will be a lull before it picks up again. So if you are thinking of investing, it's great. I think next year will be a fantastic time to get involved in property for those reasons. Right. Because those that need to sell, and there might be some financially, death, divorce, and debt will continue to happen next year. And will need to sell, and therefore they need someone to buy, and therefore there might be some bargains out there. But one of the things the pandemic has done is it's kind of guaranteed that interest rates will remain low for a very long time, I think.
True,
which again helps property. Where else are you going to get a good return? So I think property. So there are some still, some underlying drivers, and the banks still have money to lend. And so some of the elements are still there. I just think we've got a bit of volume out the way currently over the next few months. So there'll just be a little bit of a lull. And again, we don't have a crystal ball to see what's going to happen to the economy, and that always has an impact on the market.
Okay, so if someone's got some deposit and they want to buy a property, do you think it's better for them to go to this smaller, like sort of a 3-bedroom house that, well, you're going to talk about this 2+2 strategy, aren't you? Which is one strategy. Would you want to just explain what that is?
Yeah. So if you have a 3-bedroom house or a 2-bedroom house, with some reception rooms. As I said, I moved into the whole social housing sector, and social housing is, I think a vital thing in this kind of time. And, a lot of landlords don't like it. That's because they don't understand it or don't find the right tenants. I always say to people, you get good social housing tenants and bad social housing tenants, like you get good professional tenants and bad professional tenants. Just because you're on benefits or not on benefits doesn't make you a good or bad person. You're going to get good or bad people in both fields. You've got to weed them out both ways. So So don't be too scared of it, but just know it again, know and understand it. And there's some good sort of little tricks that will help you increase your rents via it by providing the right type of accommodation for people. And as I said, through the last recession, I was helping people claim because some of my tenants and I really got into it and understood that I was starting to learn more about it than tenants themselves. And so I really delved into it, and I looked through and looked for opportunities. And one of the opportunities that came up was there was a lot of single people who were struggling to get accommodation, and they didn't really want to live in HMOs, especially the older ones, but they wanted somewhere of quality to live, and they couldn't really afford to live in flats and those kind of things. And there's a little known piece of local housing allowance, which is the housing element of the benefit sector, where you could offer people, I call them flatlets, but you can offer people some better accommodation than maybe an HMO, but it's still not quite a flat, but but they qualify for the flat rate because you're giving them a bedroom and a lounge within a house. So you're giving them 2 rooms in a house. And those 2 rooms, they share a kitchen and bathroom, maybe with one other person. So if you have a 3-bedroom house with a reception room as well, you can allocate someone 2 bedrooms and another person a bedroom and the lounge, and there might be another lounge and kitchen and bathroom that they all share. So you put 2 people like that, they're getting better accommodation, so they're very happy, and your rent is highly likely to be more than you would have got renting it out as a 3-bed property. So you've increased your cash flow, you've given someone a good standard of property, and you've met a need. And these single people, and we go for generally older people because they're more settled and appreciate a good home and often look after it better. You've given them a house, and we sometimes work with charities to help house people like that. Maybe some of them have been homeless in the past, and we're trying to move them through that system and back onto their feet. And so it's hopefully it's a win-win all round, and it's an area where the council, because they don't have children, they're not a big priority, and the council have enough to do with families and higher need people. And so there's a bit of a gap, and landlords haven't been picking up that piece really, and that's why there's an opportunity in this sector, I think.
So summarize, so you'd buy say a house which has got 4 livable rooms in, which is typically like a 3-bedroom house with a reception room, and you just reorganize it so that you say, well, you have 2 rooms each, so you get 2 people there living together on benefits, and each has 2 rooms. They share the kitchen bathroom, but because they're on benefits, you don't have to worry about them losing their job or whatever, because all the rent. Now, does the rent come directly to you, or does it go to them first?
Well, it can do. There are different, it can come to you, depending on who the tenant is, how well they are able to managing the money. It can go to the tenant. Generally the aim of universal credit, which is the current benefit system, is to pay the tenant. But if there's types of vulnerable tenants, it can come directly to you. That safeguards that whole tenancy a little bit better. So there is again knowledge and systems, and certain people qualify for it to go directly as long as the tenant agrees. So yes, there is that scope.
Okay. So so could you give and just an example in sort of hard cash, just to look at the difference in how much you get if you rent it out as a just one rental unit, or is the using this 2+2 method?
Yes. So I go back to one of the first properties I bought, actually, because I then ended up doing a 2+2. So I bought it. It was a property I needed to do up. I did it up. It was reasonable condition. And I used to let it to professionals. And at the time, I used to get 725, often to a couple, so 2 people in there. And it worked well, and I got a small cash flow out of it. But once I discovered this whole 2+2, I then, when the professional couple moved out, I then moved 2 individuals into that property. And still to this day, I've got 2, separate individuals in the property. And I moved the rent to £1,000. Pounds a month, so that's an extra £275 a month.
Okay, so to give us some idea, like if you bought a property like that nowadays, how much would that cost in today's prices?
Well, it depends in which area you are, but
Yeah.
you can buy, there's various different strategies and you can use different areas. And, sometimes this works where properties are slightly cheaper in your area than
Yeah.
the more expensive ones. So you can buy the slightly cheaper ones. So the area I'm doing it now, maybe around 200-ish might work for property.
200,000.
Yeah, 200,000 might work for property. These days, you're going to get sort of more like 1,170 for that, because the rates have gone up. And one of the things the government has done through COVID is increase the benefit rates to allow more people to be able to rent, have more choice over renting, or there might be some professionals who suddenly need to claim and they haven't factored in that they would ever need to claim. And therefore they've raised the rates to fall in line more with the rent.
So if we have that in example, so suppose you buy a house for 200,000, which could typically, it might be the next local authority house, for example.
Might be next. They work quite well, yeah.
Work quite well because already sort of spacious and well built and so on. So suppose you buy them for 200,000. So how much of your own, how much deposit would you need to put into
You
that?
probably need 25% deposit,
Which is £50,000
for that. So £25,000 at the moment. You've got a bit of a stamp duty holiday, so stamp duty is not. There isn't much stamp duty, yeah, and then there's a few purchase costs. So 25,000. So you might need
50,000. So 25% of 200,000.
50,000. Yeah, 50,000. So you might need 55,000 in money, in your account to actually be able to buy something like that. Now,
Okay.
I operate in the south, so it's going to be a bit more money. If you were, say, operating in Wales or operating in,
yes,
in further north in Manchester or Newcastle, then you're going to be able to buy cheaper properties. So it's always worth doing the research in terms of yield versus price, and choosing where you want to live. I've always wanted to build a portfolio closer to me. I've always liked the capital appreciation, and historically the south has had good capital appreciation, but you can get some very good yields and better yields up north. So that's the action with up north. So you could get better yields, but if you're, say, getting, for argument's sake, 1,170, you're going to be, what's that, 10, 12, you're going to be getting, close to what, 14, 15,000 a year in rent.
Yeah, 14,000 a year. Well, I'm also, so just looking at your mortgage expenses. So in that example, you buy it for 200,000, 50,000 deposit. So you're borrowing 150,000. Now, supposing you pay 4% on your mortgage, it's an interest-only mortgage, say, that's £500 a month.
Yeah.
Of 4% of 150,000 divided by 12. So your rental income is 1,170, and your mortgage payment is 500, which is an incredible difference, isn't it? So it's £600 pure.
Yeah, so you've got 600. Yes, about around £600 difference. So that's a nice income, isn't it? Whereas if the market rent was more like 800 quid.
Yeah, supposing it's 800, then you'd only get 300.
But you'd only get.
Yeah, because your mortgage costs are the same. So by doing this 2+2 method, you're more than doubling your net.
You kind of double you quite often double your profits, or in some cases where you haven't got a very profitable property, you could, I've discovered back in the day I was quadrupling my profits occasionally, which is, that's what you can spend. Sometimes people focus on top line rents, but it's what you can spend, isn't it, that makes the difference. And quite often some of these tenants do stay a long time. I've had some of these tenants for quite a while as well. Which again breeds profitability. I call it leakage. This is the ideal rent, and then what is your leakage? And you can get leakage through arrears, you can get leakage through voids, and you can get leakage through a bit of maintenance, and so you want to minimize that too. So you've got to think of the yield, but you've also got to think about, well, the leakage. And if someone is staying in your property a long time, you never get the voids. And if they're always paying you because it's coming through the government, through the local, then you don't get any arrears. So your leakage comes right down. And generally, if there's no turnover as well, your maintenance costs go down, because when someone leaves, you might have to fix a few things, because some people get used to stuff that they have. They kind of, I can't bother to call the landlord. And the leaking tap or whatever just remains leaking for a little bit or something. But if a new tenant comes in, they immediately spot it and say, look, I need to get this tap fixed. So you fix it. So your maintenance goes up when you have a changeover always. So if you can minimize the changeovers, minimize the voids, minimize the arrears, and you will, therefore your profitability goes up a lot.
Yes. So in this example, I think so. Yeah, 1170, say 500 mortgage, so 670. So if we say 600 a month, so times 12 equals 7,200 profit, your net rental profit on that property, and you've invested 50,000. So that gives that's 14% return on investment just on the rental cash flow,
just on the rental income alone,
compared to comparable investments in stocks and shares or anything. So this is much higher, and that's not even considering any capital growth.
Yes.
But with capital growth, you could remortgage, get your own, all your money out at some point, and then it'd be
that will boost
ROI.
And that will boost your ROI. So if you imagine I was doing this and I was getting a little bit of a discount, or I'd done the property up, so I might need more cash to start off with.
Yeah.
But if I then refinanced it, or you wait 2 years, as you say, and you refinance it because the market's gone up, take your money out, and let's say you've taken, you managed to get £40,000 out, you've left 10,000 in there, and you're making, 7,200.
Yes.
A month, you're going to be making 70% on your money. I mean, it's just that's very, very good, isn't it?
It is very good.
The power of gearing and the power of recycling your money, which is why you can see why property investors are very keen to do that.
Sure. So when you buy the property in the first place, when you go to the lender, do you explain this strategy and you say you're going to get...
I don't really explain the strategy to the lender.
Because you have to give the rental income, projected rental income, don't you? And they look at comparable.
Yeah, so that, a valuer will go in and say, what is the market rate? And they'll probably put that down on the mortgage valuation. So you've still got to make sure that works under and I would always say, don't just buy a property with the elevated income, be safe, buy a property that still works on the normal market rental income.
Yeah.
And take the benefit, take the bonus. I always say it's a bonus as opposed to a right, because things can change and stuff. So
and you have to do that really, because if the cash flow was low or as a single let, you wouldn't be able to get this 75% loan to value.
Get the maximum mortgage, yes. So you still need to make it fit.
Yeah.
Back in the day as well, a lot of lenders didn't like DSS tenants.
Yeah.
But these days you're not allowed to discriminate.
Okay.
It's discriminatory. A letting agent, I think, was prosecuted up north for saying no DSS.
Really?
So there's very much a push and drive to say it's unfair. A bit like disability, a bit like don't discriminate against people. So just because of their circumstances. So so these days mortgage lenders can't really stipulate, which they did a while ago, no DSS, because they were worried that people couldn't cope or they wouldn't receive the money or those kind of things. So or maybe evict them if they need to repossess the property. It's can be a little bit harder, or a bit more politically sensitive if you're making someone who's homeless or something. So that is, but they've that is now discriminatory. So I don't think there's been a case against a mortgage company, but there was against a letting agent, and I think the mortgage companies have kind of realised that it's a bit discriminatory and it shouldn't be written in their policies. So these days it's more open with the mortgage providers, and it depends on how you set it up, because it's just like two people sharing, really. If you that way. Often friends share, don't they? 2 or 3 friends might share a house.
Yeah.
There's no problem with that. So it's kind of the same thing, rather than an HMO. If you move into HMO territory, then you would need a mortgage that is applicable to an HMO.
No,
so if you only have 2 tenants in there, that's fine. If you have more, then it would be more HMO territory.
Now, is this strategy better or worse than getting an HMO?
It's different. I think the main difference for me is you don't have to invest so much up front.
Yeah.
Because, say if you've taken that house, one, you'd need bigger houses for an HMO, and certainly down south, I think you need at least 5 people, if not 6, to make it profitable, depending on, if you've increased the value. But so you need bigger houses. So this works on a broader base of houses because there's more opportunity. So there's more houses this can work on. It probably won't return quite as much profit, but then you have less legislation. You're not paying the bills. In my area, I have to go through planning. You might need to put more money down. You probably have to. I like high-end HMOs, which means I do have to spend quite a lot of money on them. So it's just different. It's horses for courses, really. So can it be more profitable? It could be more profitable. It's usually not. It's somewhere in between, I think. You've got a single let, you've got the 2+2 strategy, and you've got the HMO strategy. But the HMO strategy needs bigger properties and more money. So you might not have that amount of money, or you might not want to manage so many tenants, or the legislative risks, the licensing, the checking of the fire alarms, all of these things that come with HMOs that seem to be more and more and more these days.
Yeah.
Do require more managing, and you will get more leakage in an HMO. So it's close. It depends on the size of the HMO, really. A small HMO and a 2+2 probably is similar-ish in profit, and a larger HMO will probably beat it.
The advantage of an HMO is that you can get commercial finance based on income, so you could potentially get all your money back fairly quickly.
So you can recycle your cash probably easier through an HMO.
Yeah.
Or certainly the way I do my HMOs. One of the main motivating factors is it requires more money in, but I can get my money out quicker than doing a 2+2. But what's nice is you can, if you find a decent value property, a smaller, a 2 up, 2 down terraced house, where you give someone the top floor, someone on the bottom floor, and they share the bathroom and kitchen. You can pick those up fairly cheaply in my area, as I said. Whereas I'm going to be spending probably close to 300,000 on a property that I could turn into an HMO, whereas I can probably spend 200,000 on a property that I can do 2+2 on. And then also, if I'm doing an HMO, I might have to spend 50 to 100,000 renovating it. I might go into the loft, might put a lot of en suites in. So depending on what I'm doing will depend on the budget for that.
Yeah, and it does seem to require much bigger skill set. You've because I've got to know what you're doing, or you could go horribly wrong if you start doing stuff like that.
Yeah, you then have to know and manage builders. So if you are starting out, the recommendation often is buy a buy-to-let to start off with. It's not too far forwards to go into, say, a 2+2 from a buy-to-let. So that's you might be able to do that first off, but just buy a simple property, get used to it all, make sure you like it, understand the elements, maybe do a little bit of decorating throughout, working with builders, see what you think, and then build up to an HMO. And most HMO mortgage lenders these days want to see that you've had a buy-to-let maybe for 6 months.
Right.
Anyway, it's not always a criteria, but it helps with your mortgage application if you have. And there's a reason, it's just building that experience base up. Again, I guess if you're buying and selling shares, you're probably not going to jump in with both feet. No. There's money to start off with. You probably invest a little bit and see how it goes, and then invest a bit more, and invest a bit more.
And with the 2+2, you don't particularly need to do it up at all, do you? There's no structural changes.
No, you don't. I often see people over-speccing properties. Obviously you want a nice property, a clean and tidy property, but I had a mentee who is renting to social. He bought a house that originally, and it sort of completed just around the whole lockdown pandemic. And he was going to do a big refurb. And I said, look, let's keep things simple. Let's not spend so much money because we don't know what's going to happen. Is property prices going up and down, and you might leave all this money in and have to wait to unlock it for a while. Yeah. Let's just do a minimum refurb. You can get some good money with some LHA tenants. Yeah. Some LHA tenants. And he did a wonderful job. He just, instead of gutting the whole place or whatever, he replaced the worktops and doors in the kitchen, and that looked really nice. Just the whole place white.
Yeah.
Looked nice. And then put new carpets in. But the new carpets, when he showed me the pictures, I said, "Oh, I thought you said you were changing the carpets." He said, "Yeah, no, the new carpets." But they were old-fashioned carpets because he bought all the end of roll carpets. He got a big deal on them. So they were new carpets, but they might not have been to our taste.
They looked old, okay.
They didn't look old. They weren't to our taste. I think the taste, fashion had moved on a bit. So they were patterned carpets, but they don't show the markets, do they? So they often say, actually, buy-to-lets should have patterned carpets because you don't show the dirt. But because they're unfashionable, I don't necessarily put them in. But
sure. So it seems like if you're doing this 2+2, the main skill you would need is to learn how to get tenants, which probably is just like learning how to advertise. And because the person coming along probably isn't like an expert in benefits, and they probably don't. So you'd have to master all the knowledge yourself. Then have to explain.
You need to master the knowledge yourself.
Help them show how to claim.
Because a lot of people have said, "Well, I've tried your strategy; it doesn't work in my area."
Yes.
Why doesn't it work? And they said, "Well, I advertised for 2 rooms in a house, and it didn't work." Well, people aren't thinking, "Yes, let's go out and look for 2 rooms in a house." They don't know that concept exists. They don't understand it. They don't understand. So they know of house shares, they know of HMOs, and they know of flats, but they don't know of this thing. If you try and advertise and say, "Come to my 2 rooms in a house," someone will go, "Well, I'll just buy a room because I'll qualify for a room rate if I get a room, and I'll qualify for a flat if I get a flat."
Yes.
Quite often the flats are a bit above the benefit rates, so they can't move in, or they haven't got deposits and the upfront rents and all of these things, so they can't necessarily move into flats. Although they want it, they can't. So you need to attract the tenants in and then sort of explain the benefits, and that's why I said earlier I call them flatlets.
Yeah.
Because you have your own bedroom and your lounge, and of course that means you can watch your own TV program, you can lounge around yourself. But the good thing is especially in times like this, if you've been locked down, you've got someone else to talk to. So you've got the best of both worlds. You've got a bit of private space and you've got a bit of communal space. And you're just sharing with one other person, so it's not as though you're sharing with lots of people. And once you start phrasing it and talking about it like that, they start, and probably their alternative is to rent a room.
Exactly. So this is brilliant for them because they get 2 rooms
level up.
One, and it's all paid for by the benefits anyway. So.
And then they qualify because if they're slightly older, they'll qualify for that rate.
Do they have to be a certain age?
You have to be over 35. If you're under 35, you can't qualify for the 1-bed flat rate, the 1-bed rate. Right. It's something the government put in place so anybody under 35 does have to have a room. If you live in a couple, then you can get a flat or you can get this rate. But if you're a single, a younger person,
so it would work if they were a couple, this would work.
If this was a couple, it would work. But I don't tend to do it to couples. But it could work on that. A younger couple could work. But I don't tend to do that because then it unbalances the household.
What I mean is, if you do 2 flatlets, 1 flatlet to
one flat for one couple and 1 flat for the other couple.
No, 1 flat.
I mean, for the other half of the couple.
There's just 2 people living
they're a couple.
in a relationship.
If they're a couple, you shouldn't probably be putting them in like that because if they're living together.
They shouldn't really.
It's a grey line. It's a grey line, really.
Probably breaches the.
It's a grey line. I'm never quite sure. So it's a grey line.
There is, depends if they're one household or not. If they're one household, they wouldn't get that same rate.
Should they be claiming together and therefore they've been entitled to one rate
like
themselves? But it's a good idea, Keith. I like it. It's a good idea.
It is, yes. So, and also, have you looked into serviced accommodation at all? Or Airbnb?
I have looked into service accommodation, and I've done a little bit myself. I like to try all these things and work it out. Now, service accommodation is good. I mean, obviously, that is something that has been, heavily affected by the pandemic, and certainly in lockdown, you would have really suffered as a service accommodation provider. My observation is that you're moving from being a property investor into. Are you still there?
Yeah, I am. Yeah.
Oh, yeah. Sorry, something happened on my computer. Okay. I thought you disappeared because you were there. So you're moving from a property investor, landlord, into really being a hotel operator, into being
It's a whole different skill set. You've
A
got to be
different skill
really
set.
good, haven't you? You've got to.
So you're in the what do they call it? The services sector, not the services
Yeah.
sector, but the hospitality sector. That's what.
Yeah.
So you're in the hospitality sector. There's a lot more work. There's a lot more changeover. So yes, your rent is going to go up if you can fill it.
Yeah.
There's a lot of activities to do so, and then you've got to change the sheets, do the cleaning.
Yeah.
And yes, if you delegate it out to people, yes, but then that takes a lot of the lion's share away. So as a business owner, I like to scale, and I'm already letting to professionals, I'm letting to social housing, and they have different systems. So introducing a new fully system to scale was going to be quite complex.
Yeah.
And I thought you either you can do one or two, or if you're an individual and you've got a handful of properties, you could probably manage a handful yourself.
Yeah.
But like me, I like to delegate. I have a team. I've set up a business I always think property investing is a business. So you want to scale. So I wanted to scale, and I looked at it and I just went, it's not something I really want to scale. I know under 9/11 that, hotels, service accommodation took a massive hit. That could happen again. Guess what? It's happened with the pandemic.
Sure.
But also, if you're following mortgage terms and conditions, you should have a specialist mortgage for this kind of thing. So again, if that's harder, that puts you need to be looking into that and making sure you're all correct. So I want to be correct along the way with my property investing. And the other element is always there's this question mark over, should you be changing the planning use? Because short-term accommodation is technically, again, a different planning use from C3. So you can let out a house for up to 90 days. And in London, there's a 90-day ruling, which a lot of people ignored, and they could get fined. And then I think they pulled it down. And so, for example, if you're in London, Airbnb will only let you advertise, rent out for 90 days through their platform.
Right. Okay.
So again, I looked at that constraint, and again, I just thought some legislation could come in and you could topple your whole business. So I wasn't that prepared. And a lot of people do it, and they do it successfully, but I don't know whether they've thought through all of that. So I'm not against it. And it's easier outside of London than in London, and I was doing it in London.
Yeah.
And again, that works on a rent-to-rent basis very well. And that's how you scale that business quickly, is on a rent-to-rent. But maybe you do it on a management fee basis as opposed to a guaranteed rent. So therefore, if your income does fall, it does fall, but you haven't got all this liability that's there under guaranteed rents to landlords. So that might work better, I feel. But it does work. And there's a lot of successful people out there, and there's some big companies out there doing it very successfily. So yeah, it does work. But I just decided it wasn't for me, too many moving parts. And I didn't want to get into that business. Yeah. I can see the attraction though.
Okay. Well, we've been, speaking for about an hour. So obviously I've got to be respectful of your time and everyone else's time. So we probably ought to come to a halt about now. But if someone wants to find out more about this or to work with you, I know you have a webinar, don't you? Would you like to say a bit about that?
Yeah, we run, monthly webinars. There's normally one on the social housing sector at the moment, because that's quite topical. A lot of tenants are being made employed. So we do the social housing sector. We also run commercial finance events as well. So jump on one of our webinars, which I believe you're going to.
Yeah, if you look in the description, we're watching this video. In the description, there's the link, a bit.ly link to.
Or if you want to get in touch with us, do pa@mikefrisby.co.uk. So pa@ Frisby, and Frisby is spelt with a Y, so MIKEFRISBY.co.uk. And then we can connect. So if you're wanting some individual mentoring,
you do that, do you? Individual?
I occasionally do that. I do a lot less of that these days.
Yeah.
But I have other programs that also, as well as the social housing, I have other programs that help people with HMOs. I help people just get into property too and scale their property business. I'm also very good at taking a sort of a property investor who's got a few properties and scaling it so that they can jump out of their. A lot of people are doing this to jump out of what they're doing, to give them a bit more time and freedom, and it's certainly why I got into it myself. So I help scale a property business too. That's something I really enjoy, watching people grow and benefit. So I've recently helped someone set up like 6 HMOs that they rented to charities, so guaranteed rent, so very hands-free.
Yeah.
I was mentoring them through that process. I've been
Mm.
running a group last year to set up HMO businesses or accelerate their HMO business, and they've been flying. So I just enjoy this side of it. I enjoy that interaction.
Yeah.
Enjoy helping people, and enjoy seeing people, do well in property,
Mm.
and sometimes it changes their life. So it's always nice to be involved in that with people. So I do it for that reason. Obviously there's a financial reason as well, but it is a kind of an enjoyment. I get energy from it. So
Yeah.
I do enjoy sharing my knowledge and
Mm.
helping people. And one of the things I think I'm quite good at is seeing deals and looking
Yeah.
at angles that a lot of other people, hence why I've come up with these social housing strategies, and hence
Yes.
why I understood the whole recycling of cash and
Yeah.
marketing to direct to vendors. So I will probably do things, not that the novice property investor wouldn't, and we can really help people accelerate their journey by getting to know.
Sure. Well, I think it definitely helps someone, to have someone like you to help, because you don't know what you don't know. But if you have someone else who can see things with their, years.
Yeah, and I think that's what some people don't. They go, "Oh, I don't need that because I
Yeah.
know what I'm doing." And it's, as you say, they don't know what they don't know, and they could
Yeah.
be either falling into a pitfall or they could be accelerating their journey more. So they might get on fine, but they're, and I do come across people, and it's like, gosh, I wish I knew this earlier back in the,
Yeah.
So as you say, you don't know what you don't know, and I still come across things, even this week, because I often get people in to talk to my groups and things like that, and I learn off a specialist around, for example, the stamp duty arena. That there's certain things you can do to really help, mitigate stamp duty. They're all legal.
Yeah.
What's written in the code from the HMRC. So it's nothing about, but we all don't sit down and read, social housing, the details in the social housing, the details in the stamp duty, the details in all the mortgage lending, the details, what you can and can't do. We don't sit down and hoover all of that up. But there's by sharing and masterminding and working with people, it certainly helps. And also on the motivational side, which I think is, property investing can be a lonely thing. And I find that a lot of people get very passionate about property, so they want to talk to people, and rather than boring all your friends, come and talk to people who are also interested in talking property. Amazing. And get your energy and accountability from that as well. So that's another key part of me helping people is keeping them focused on their goals, helping them set their goals in the first place, realistic goals, and seeing how they can achieve it, helping them overcome the hurdles, but stay on track, stay focused, and stay motivated, really, which is one of the key things of business and life, really.
Yeah, well, that sounds great. Well, thank you very much for coming on the show, and I'm sure hopefully a lot of people will get a lot of really great information from this call, and it's maybe opened their eyes to, the sort of profits that are available if they just if they start adopting some of these strategies. So we'll wind up there, and wish you all the best, and see you soon, hopefully.
Yeah, thank you very much, and thank you for inviting me on.